This AI-generated podcast is for general information only and does not constitute financial or legal advice. Listeners should independently verify all information. Please consult a qualified professional.
Welcome to the Luxembourg Fundcast. Produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 5 June 2026.
So, most procedural discrepancies in private banking, they do not happen because a product structure is inherently flawed.
Right, no.
I mean, they happen because a single mandatory document reaches a client, say, 3 minutes too late, or arrives bundled improperly in a digital interface.
Exactly.
Today, we are doing a deep dive into the exact legal sequence required for client onboarding and product distribution. Specifically, we are examining the standard operational parameters surrounding the key information document, or KID.
Yeah, it is a highly specific sequence.
It is. And to anchor our discussion, we will establish one primary thesis today. The delivery of the key information document, or KID, is a mandatory pre-commitment control, not merely an administrative formality. The KID must be provided in good time before the retail investor is bound.
Right. We are mapping the exact procedural life cycle required to execute that pre-commitment control. But to establish the foundation for this standard operational parameter, we must first consult the primary legislative text governing these disclosures.
Okay, let us get the exact source on the record.
This is Regulation EU, 1286/2014 of 26 November 2014 on key information documents for packaged retail and insurance-based investment products.
Okay, that is a long title. For our operational analysis today, let us establish the shorthand right away. We will refer to this as the 2014 PRIIPs regulation.
Perfect. So the text establishes one mandatory chronological sequence. Under Article 13 of the 2014 PRIIPs regulation, the delivery timing is strictly controlled and it must precede the transaction. The legal requirement dictates that the delivery of the KID must occur prior to the investor undertaking any binding commitment.
Which reinforces our primary thesis from the outset, right? Providing the key information document in good time before the retail investor is bound is a mandatory pre-commitment control, not merely an administrative formality.
Yes, exactly. And to operationalize this control within your own firm, private banking teams must implement 3 specific verification steps.
Well, let us walk through them. What is the first check?
Well, the first check involves confirming the retail status of the investor and, verifying the specific product perimeter.
Right.
This foundational step is governed by Article 4 of the 2014 PRIIPs regulation.
Let us look closely at the mechanics of that first check. Article 4 of the 2014 PRIIPs regulation defines the product perimeter based on the structural characteristics of the investment. Specifically, the text notes that investment products with indirect exposure to underlying assets may fall within the scope of the regulation. So, if you are programming a compliance algorithm to flag in-scope products, how exactly do you instruct your operational teams to test for this indirect exposure?
Good question. The assessment of whether a product requires a KID, it hinges on identifying fluctuation risk derived from assets not directly held by the investor.
Okay.
So the operational test your teams must apply is a look-through mechanism. They must examine the product to see if its payout is subject to the performance of reference values or underlying assets.
Right, like consider a structured note or a special purpose vehicle where the return is linked to an equity index.
Exactly. Even if the investor does not hold the equities directly, that indirect exposure exists. If that exposure is present and causes the return to fluctuate, well, the product falls firmly within the regulatory perimeter established by Article 4 of the 2014 PRIIPs regulation.
What if we adjust the structural parameters? Well, if an institution utilizes a highly specialized corporate legal vehicle to hold the underlying assets, how does the legal form of an investment product influence its inclusion within the scope defined by Article 4 of the 2014 PRIIPs regulation?
It does not. The legal form does not alter the analysis at all. The regulatory perimeter defined by Article 4 of the 2014 PRIIPs regulation does not grant exclusions based on the legal structure or corporate holding method of the vehicle.
So it is strictly about the exposure.
Exactly. Whether the product is structured as a dedicated fund, an insurance contract, or a securitized note, the determining factor for inclusion remains the presence of indirect exposure to underlying assets. Private banking teams must conduct this first check strictly on the basis of economic exposure. They have to disregard the legal form of the product entirely.
Got it. Okay, following the initial verification of scope and investor status, the second check focuses on the physical or digital format of the document itself.
Yes, moving to the format.
We transition from identifying the product to applying the standard operational parameters required for the pre-contractual disclosure.
Right. And the standard operational parameters for the document format are established under two specific articles. First, Article 6 of the 2014 PRIIPs regulation mandates that the KID must be a standalone document.
Okay.
It must be distinctly separate from any commercial materials. Second, Article 14 of the 2014 PRIIPs regulation requires that the delivery of this document must be provided free of charge to the retail investor.
I want to challenge the operational execution of that first requirement, just practically speaking.
Go ahead.
In modern private banking, relationship managers often utilize secure digital portals to communicate with clients.
Sure, very common.
If your digital platform sends a single email containing a secure zip file, and that file holds both the commercial deck and the KID, well, you have streamlined the communication.
Yeah.
So what is the precise risk of procedural discrepancies if private banking teams merge commercial materials with the key information document in this manner?
Failing to maintain a standalone document results in direct compliance nonconformity under Article 6 of the 2014 PRIIPs regulation.
Wow, okay.
Yeah, merging the KID with commercial materials, even within the same digital file or zip file, directly contravenes the standalone requirement. The document must remain distinctly separate to serve its function as a neutral, objective, pre-contractual disclosure.
So no bundling whatsoever?
None. Any integration with commercial materials, whether physical or digital, it constitutes an operational gap in executing the pre-commitment control. Your user interface must present the KID as an independent regulatory disclosure requiring separate acknowledgement.
Okay, but what if the user interface displays the commercial brochure on screen 1 and the client must click a button to view the KID on screen 2? Does that satisfy the separation requirement, or does the sequential presentation within the same commercial flow create compliance nonconformity?
Well, that sequential presentation requires very careful technological configuration. According to Article 6 of the 2014 PRIIPs regulation, the separation must be unequivocal.
Unequivocal, right?
If the platform designs the flow such that the KID appears merely as an appendix or a subpage to the commercial brochure, you risk nonconformity.
I see.
The operational parameter demands that the client perceives the KID as a distinct regulatory control document, not a continuation of the commercial communication. Furthermore, applying Article 14 of the 2014 PRIIPs regulation, your platform cannot bundle any access fees or platform charges that would restrict the client's ability to view this specific document free of charge.
This required separation from commercial materials highlights exactly why the KID functions as an objective pre-commitment control, not an administrative formality.
Precisely.
The separation ensures that the disclosure functions purely as a regulatory requirement. Which brings us back to our primary thesis. The delivery of the key information document, or KID, is a mandatory pre-commitment control, not merely an administrative formality. The KID must be provided in good time before the retail investor is bound.
Yes. It cannot be leveraged as a commercial instrument. And once your operational teams have confirmed the scope under Article 4 of the 2014 PRIIPs regulation and ensured the digital or physical format complies strictly with Article 6 and Article 14 of the 2014 PRIIPs regulation, they must execute the third check.
And this third check assesses the specific timing criteria for delivery.
Exactly.
To dissect the timing assessment, we must introduce the secondary legislative text governing this process. This is Commission Delegated Regulation EU 2017-653 of 8 March 2017, supplementing Regulation EU No. 1286-2014. For our operational mapping today, we will refer to this as the 2017 Delegated Regulation.
Correct. And the exact operational parameters for delivery timing are governed by Article 17 of the 2017 Delegated Regulation.
Okay.
This article sets the assessment standard for determining what legally constitutes delivery in good time. It is not a static metric.
Right, it varies.
Yes. The advisor or the seller is required to evaluate 3 specific criteria to determine the appropriate timing for each distinct transaction.
Right, and the 3 specific criteria outlined under Article 17 of the 2017 Delegated Regulation are investor knowledge, product complexity, and investor-led urgency. The advisor or seller must assess all 3 factors objectively.
They must.
Let us look at the mechanics of that assessment. How do you build an operational framework to quantify these 3 variables consistently across, thousands of daily transactions.
Well, the assessment standard under Article 17 of the 2017 Delegated Regulation requires a qualitative evaluation translated into systematic controls.
Okay, how so?
First, your systems evaluate investor knowledge regarding the specific type of investment, often drawing data from the client's established profiling questionnaires. If the knowledge level is basic, the system must mandate a longer absorption period before allowing commitment.
That makes sense.
Second, they evaluate product complexity. A highly structured derivative naturally requires more time to comprehend than a standard accumulation fund. The system should assign a longer mandatory holding period based on the product's internal complexity score. And finally, they evaluate investor-led urgency.
Let us pause there.
Yeah.
That third variable, investor-led urgency, it seems prone to operational gaps. I mean, if a relationship manager is approaching the end of a reporting quarter, they might categorize a transaction as urgent to expedite the process. How does a firm prevent internal timelines from overriding the regulatory standard?
That is a critical procedural distinction. Under Article 17 of the 2017 Delegated Regulation, the urgency must be strictly investor-led.
Strictly investor-led.
Yes, you ensure conformity by requiring verifiable documentation of the client's initiation. The assessment must reflect the investor's explicitly communicated timeline, for example, a time-sensitive market opportunity they wish to capture, rather than a firm-imposed deadline or an internal administrative target.
Right.
Your CRM system should require the relationship manager to log the specific client instruction that justifies the urgency before any compression of the good time delivery window is authorized.
Evaluating those three criteria, knowledge, complexity, and client urgency, allows your private banking team to fulfill the standard operational parameters for timing. However, the regulation also addresses the reality of modern distribution, right, where face-to-face interaction is frequently not utilized.
Yes.
This brings us to the limited exception provided for distance communications.
Exactly. The rule governing distance communications is located back in the primary text. Specifically, Article 13.3 of the 2014 PRIIPs regulation details the strict protocol when communication takes place at a distance, such as via telephone or secure messaging.
Right.
While private banking teams may utilize these distance communication channels, they must adhere to rigorous operational parameters.
Let me present a scenario. If I am operating a strictly digital onboarding platform where the entire client relationship is managed remotely without physical interaction, does Article 13.3 of the 2014 PRIIPs regulation provide a broad waiver for timing execution? Does it allow the platform to bypass the pre-commitment delivery window as long as the transaction is logged?
It absolutely does not.
No waiver.
No. Article 13.3 of the 2014 PRIIPs regulation provides a narrow conditional exception. It does not efface the general requirement to provide the KID before the investor is bound.
Okay.
To rely on this exception without creating operational gaps, private banking teams must implement rigorous internal documentation. They must document 3 specific elements before the binding commitment occurs: the specific distance delivery channel used, the precise timing of the deliverer, and the objective rationale for utilizing the distance communication exception.
Let us examine the mechanics of that rationale. If the entire business model is digital, is convenience a sufficient rationale under the regulation?
Mm-hmm.
Or must the firm prove that providing the document prior to commitment was technically impossible given the specific distance communication method chosen by the client?
The standard requires demonstrating that the use of distance communication prevented prior delivery and that the client explicitly consented to receiving the KID after the transaction. If your digital platform allows the transmission of documents, which almost all do, it is very difficult to justify why the KID could not be provided before the client clicked the commitment button. The exception under Article 13.3 of the 2014 PRIIPs regulation is primarily designed for scenarios like telephone orders, where instantaneous document transmission is physically impossible.
Oh, I see.
If you are operating a digital portal, the platform can and must display the document before the binding commitment.
Therefore, without documenting the delivery channel, the exact timestamped timing, and a legally valid rationale that aligns with the technical limitations of the medium, the firm risks immediate compliance nonconformity.
Yes, exactly.
The narrow exception granted by Article 13.3 of the 2014 PRIIPs regulation must be supported by this verifiable documentation before the transaction is finalized, and the client must be given the option to delay the transaction to receive the document first.
Precisely. The distance exception does not alter the fundamental operational control. The delivery of the document remains a pre-commitment safeguard. The rigorous documentation of the channel, timing, and rationale within your internal systems serves as the required evidence that the control was properly executed under the specific parameters of distance communication. Any automated portal must be programmed to respect this sequence.
Which brings us to the final reinforcement of our primary thesis today. Whether assessing structural scope, managing digital format separation, or evaluating timing, the overarching mandate holds firm. Despite any narrow exceptions for distance communication under Article 13.3 of the 2014 PRIIPs regulation, the delivery of the Key Information Document, or KID, is a mandatory pre-commitment control, not merely an administrative formality. The KID must be provided in good time before the retail investor is bound. Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Listen also to the French edition of the Luxembourg Fundcast.
Subscribe to Bertrand Mariaux and Rigore Media on YouTube. Connect with Bertrand on LinkedIn. Read the full analysis of the podcasts at bertrandmariaux.com, all links in the show notes. This was the Luxembourg Fundcast.